Okay, continuing on with Standard 5, which is all about investment analysis, recommendations and actions. So the Standard 5 verse Part A is all about diligence and reasonable basis. So this is making sure that we're being diligent about the way that we do analysis and then how we communicate that with clients as well. So a few notes here again: only take on work that can be adequately handled. So don't say that you'll do technical analysis of the whole Russell 2000 and you'll update them every week. It's unlikely that you'll be able to perform technical analysis on such a big universe and update all of those charts that often. So again, make sure that you're taking on an adequate amount of work so that you can do your work properly is really what this comes down to. Now, of course, CFAs tending more to the fundamental side. This is a bigger issue if you are doing more of a fundamental analysis and looking at supply chains, etc. But nevertheless, no matter which discipline you follow, this is an important one to remember. Engage in sufficient scenario testing, and obviously do not present just the best case. So again, for us, if we're doing technical models, quant models, we need to make sure that we're testing those models over many different periods, many different phases of the markets, and making sure that we are presenting a really robust set of numbers to our clients. Reports must be updated for new information. Again, this is an important one when you're doing backtesting, quantitative modelling, etc., that when new data comes along and we enter a new bull market, bear market, etc., that those reports are updated. So if there's a report on how your quantitative model is working, then that needs to be updated on a periodic basis. Now, the standards are pretty quiet on how often it should be updated. It's really being reasonable. And I think what becomes most important is if there's been a significant change in the market environment, and yet we are still marketing our services based on a model from a bull market when it performed wonderfully, I think that's when we would get into trouble. So we need to make sure that we are updating models for recent market behavior as well. No need to disassociate from group opinion so long as the decision-making process is sound. So we've talked about it before that part of our responsibility is to disassociate from any type of breach or something like that. So if someone or the firm is doing something illegal and we've told compliance but nothing's actually changing, then we would have to disassociate. Now, in this case, what the standard is implying here is that if we are part of a group that's doing analysis on a security and we are thinking that disagree with the outcome of what everyone else in the group says, we don't have to disassociate so long as the process that was done was taken through the decision making was sound. If that was a good process, yet people have a different opinion, that's fine. You don't have to disassociate from that type of analysis and the results of that report or that opinion. Make efforts to check third-party research is sound. So if you're going to rely on third-party research and then use that as part of your recommendation to your clients, you've got to do your own due diligence into that third party. Make sure, understand their process and make sure that you are comfortable with that and can have that discussion with your clients so they understand where the research came from and your opinions on it and how it works, etc. Full analysis of sub-advisors and sub-managers. Again, similar concept as the previous point, just making sure you do that analysis. Understand quantitative models and inputs. So if part of your process is you're relying on a quantitative model, either for execution or for advice to clients, you need to make sure that you understand that model and you understand what the inputs are and you understand what the ratings are that are coming out of that model. So very important there. And then finally, a failed investment is not necessarily a breach. So long as due diligence and there was a reasonable basis for the decisions that you made, then it is not a breach to have a failed investment. It happens to all of us. Okay, so let's have a look at a sample question here. So Helen Back, CMT, is the founder and partner in a quantitative hedge fund. She has developed a proprietary factor model that tracks social media patterns to identify market supply and demand trends. Her model was developed and tested using 12 months of data, and based on the evidence, she concludes that the model will generate trading signals that will result in outperformance over the coming 24 months. Sounds like a good model. Ms. Back has prepared a research report in which she clearly explains these elements, and she has distributed the report to the fund's partners, but not to her clients. In the report, she makes a recommendation that the fund implement the model. What standard has Ms. Back violated? So is it misrepresentation? Well, no, she's not used someone else's material without giving credit where that's due. So it's not there. Fair dealing. She's telling the partners, now it's a quantitative hedge fund, so it's not a fund that's advising clients to act. The fund is trading on behalf of the clients. So it's not like they're trading for themselves before trading for before giving the clients an opportunity to trade. So it's not fair dealing. Performance presentation. She's, that's possibly a concern, but it does say that she's prepared the research report and she clearly explains all of these elements. So probably not performance presentation, but diligence and reasonable basis is definitely something which is a violation here. Only testing on 12 months of data and then making a assumption of what's going to happen over the next 24 months is really not enough. There needs to be a lot more research done into a model like this, much wider period of time. And I think it really is, particularly it's that 24 months afterwards. For instance, if she had done her analysis on 12 months of data and said for the next month, this is what the expectations are, well, that probably would be reasonable. But to have twice as much in the forecast in this report, but then what the test data was, that's where we would come into an issue with diligence and reasonable basis. Okay, standard 5B, which is communication with clients and prospective clients. The standard is actually quite interesting here, where it really doesn't differentiate too much between how we communicate with clients and prospective clients. So obviously prospects, we're marketing to them, we want them to become clients. So very much we have to have a very open book when it comes to how we communicate both with clients and prospective clients, and there's not much differentiation which is allowed there. So a couple of points again: must explain the investment process even if it is complex. So you can't say to a client, I make 20% per year in the markets, but our whole process is proprietary and I can't share it with you. You've just got to trust us. Well, that would actually be a breach of communication, so a breach of this standard. Opinion must be distinguished from fact in research reports. It's okay for us to have opinions. And remember when we talked about in Standard 2, the mosaic theory, well, we are taking lots of non-material information which is public or non-public, again with material information which is public, and we're piecing that all together. But at the end of the day, it's our opinion that stock, etc., is primed for a move in up or down. And so opinion's okay, but we do have to make it clear. We have to make it obvious to the clients that this is our opinion based on all of these factors, and that's okay. But it's only when we say this is what's going to happen, especially to a unsophisticated client who really doesn't understand the distinction. Very important that we're very clear on that. Fully describe characteristics of investments, so what the investment's made up of, particularly if it's derivative or complex in some form. Notify all clients and prospective clients of changes in the investment process. So if there's a IPS being used and part of that process changes, then all clients have to be notified, and prospective clients as well. So if someone's thinking about coming along and then there's been a change while they're in that onboarding type process, they've got to be informed about that as well. Notify clients about errors and corrective processes. We've talked about that many times through this study of the standards. Errors are not a breach of the standards, but were we to fail to let our clients know, then that definitely would be a breach, and we would definitely have to make sure that the clients are informed about that. Okay, so looking at a question here. Carson Buses is preparing a report on Blanding Inc. Blanding's earnings have increased in each of the last 6 years by an average of 11.8%, a nice compound there, based on his analysis. Buses projects that the Blanding's earnings will increase by 12.5% in each of the next 2 years. So there's a good set of 6 years of data being studied, making a forecast over the next 2 years. So, that's okay. Which of the following statements, if they were included in Buses' report, would violate the CFA Institute standards? So if Buses would say Blanding's earnings growth continues to be impressive, that's okay. That's no problem there. Blanding's earnings growth is expected to exceed 12.5% annually in future years. That's his opinion, and it's expected. The word expected there is a subjective term, if you like. So, that's fine. Blanding's earnings have been compounding at approximately 11.8% annually. That's a factual statement. It's true based on the research. That's fine. D, Blanding's earnings will grow at 12.5% annually each of the next 2 years. This is the statement that would be in violation, and it really comes down to that word will grow. We don't know that it will grow. We can't say, especially to an unsophisticated client, this is going to happen. The market is going to do this. The S&P is going to go up or it's going to go down. We don't know that. Not until the next day happens or we get next year do we know for certain. So it's far better that we're using terms like, we expect it to grow, based on this information, based on this research, based on what we've seen happen before, based on these crossing of moving average indicators. This is what we expect to happen. And when we use terminology like that, then we keep safe for our clients, and we're letting our clients know that yes, it's based on our best professional opinion, but it's not a certainty. But we also stay safe as far as it comes to the standards here in the Code of Ethics. All right, Standard 5C, which is record retention. So we need to retain the investment policy statement and changes to it, so a history of investment policy statement as well, recommendations and the basis for actions. So if we're going to trade on behalf of our clients, we need to have written proof, written record retention of the reasons why we are making those trades. Record all second and third party research, if any was used, and again, keep that as part of our record retention. Records are the property of the firm, so when we work for a company, they always belong to the firm. We're never allowed to take them away. In the absence of regulatory guidance, keep for 7 years. So again, this is that stricter law type model. If the country in which you're working in does not require record retention, well, the CFA Code of Ethics does require you to keep it for 7 years. Okay, final question here for this standard. Rick Shaw, CMT, recently joined Bloomington Investments as a research analyst. After spending an afternoon looking through the research team's archives, Shaw is not sure that Bloomington maintains the records that support the team's analysis and recommendations for the minimum 7-year period called for by the standard. What is Shaw's most appropriate course of action? A, keep his own records of the relevant records and maintain them at home for a minimum of 7-year period. Well, no, we're not allowed to take records away from the firm. They are the firm's property, not ours. So A is not an appropriate action. B, decline to participate in any new research until he can verify that the firm is in compliance with the standard. It's not what the standards require us to do. Again, this is kind of like that disassociate type rule. It doesn't really apply into this section. It is not really up to Shaw to decide that, because full compliance may take 7 years to get to that point where there's 7 years of history. So is Shaw saying that he will not participate in any research until 7 years is up? He's not going to hold on to the job if he does that. C, review the firm's record retention procedures with his supervisor or compliance officer to ensure that they comply with the standard and or suggest ways to bring them into compliance. Well, that sounds like a really good, appropriate action to take. And then D, document his opinions about the firm's record-keeping procedures for his own records in case any enforcement action arises. That would not be appropriate. It's really saying, I know the company is doing something wrong. I'm not going to tell them. I'm just going to cover my own backside and keep records in my own home that I knew about this all along. That would not work. A, it's not fulfilling our duty to our employer, but B, it's like there's a problem, but you're not bringing it to the compliance officer's attention. You would definitely document, you would definitely let the compliance officer know in writing so that you have documentary proof that you have done so. But yes, obviously in this case, C is the only answer, which is an appropriate action. All right, we'll continue with Standard 6 in the next video.